Hello, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is our good friend, Larry McDonald. He is the founder of the Bear Traps Report. Larry, welcome back, sir.
Ivan, thank you very much for having me. I love the platform.
Yeah, it's always a pleasure having you come back to the to Wall Street Silver and talking to the audience, everything about what's happening with back in the Lehman crisis and everything that's happening now and how it's connected. And last time we spoke about 3 months ago on Wall Street Silver, we were talking about more disturbing trends, economic trends coming into play either this year or next year. And one of your books is a New York Times bestseller, and it talked about the Lehman crisis. Do you believe now we are facing a bigger crisis than just even 3, 4 months ago, like looking at the market? What do you think?
Yeah, well, 3, 4 months ago was more okay. Regional banks and the hold to maturity losses because of when interest rates go up, bond prices go down.
Hmm.
And when central bankers lecture people for long periods of time that they have inflation under control, a lot around the country, a lot of regional bankers, reached out too long, bought longer term bonds, and when interest rates go up, those bonds can fall by a lot. I mean,
Hmm.
there's an Apple bond that was issued in 2020 that's trading in the 50s now,
Wow.
50s, and there's a couple in the 60s. Like that's bonds backed by Apple because it's like a 2060 maturity, 2060,
Wow.
60. And so when interest, and it's like a 2.5 or two to 2.5% coupon. So when interest rates go up, that bond, because of its duration, can fall, I mean, just incredibly fast. And the lower the coupon and the more rates go up, the more that bond can fall. So, but what's happening, Ivan, the most compelling thing, so behind me right now, we run a live Bloomberg chat with about 650 institutional investors in about 23 or 25 countries or so
Wow.
around the world. And when I did my first book, I did a lot of speeches around the world. So I met some incredible people, and a lot of them are in the chat, and some of them contribute content, and other people just observe.
Right.
But the big telling point is the last 2 weeks, American Express is down 22%, LVMH, which is your Tiffany's, your high end consumer companies in the boat space, yachting sales. Nordstrom's, the high end is really starting to come down. And that was holding up consumption, right? That was
Hmm.
the part of GDP that was the strongest.
Right.
And so 6, 9 months ago when we talked, I think maybe 6 months ago, we had the consumer weakness on the low end, but the high end was really holding up things. And you made that point. And now you can clearly see a deterioration across that. The other angle is the percentage of New York Stock Exchange stocks that are above the 200-day moving average,
Right.
2 months ago was 60, 70%. Back in February, I should say going back to February and then through the summer, it was
Hmm.
in the 60 to maybe 50% range. And now we're down to about 41%. So the breadth in the market is deteriorating, but all summer, what held up the market were the magnificent seven. So even though the breadth deteriorated, the big stocks, the top 12, were holding up things. Now the big stocks are starting to give way as well.
Right.
And so that speaks to a rough time for stocks the next 8 weeks.
And what are you seeing? Like a lot of people online and on the forums that I'm seeing, they're talking lots about a regional bank collapsing, whether it be Bank of America or something coming up soon. And what will that affect, Larry? If let's say hypothetically, Bank of America stock collapses, there's a huge issue, and then what does the Fed do? Do they need to turn on the printing machine and start pumping out liquidity? Do they lower interest rates? What happens if a big regional bank collapses, let's say next month?
That's the key to the precious metals trade because what
Right.
kills precious metals, and we're buying silver and gold miners the last, I guess last couple of months we've been buying quite a bit, and we're in some pain. But when the Fed gets up there and they pound the chest and say, okay, we're going to keep rates here, we're going to go to maybe 6% Fed funds, and they basically look out into 2024 and say, oh yeah, we're going to hike next year.
Right.
And that is just bravado. And they're trying to kill inflation with vocal cords, right?
Right.
And it works for a certain period of time. The problem is the hold to maturity losses in the banks on the bond side. So you've got treasuries that are down at least $1 trillion of losses on treasuries.
Jeez.
Probably 2 trillion if you count what happened. The Fed owns though. There's one bond that the Fed owns. They own this 1.25% bond in 2050. That bond, they've lost $7 billion on one bond.
That's crazy.
One bond,
That's
which
funny.
I tweeted it. I don't know if you can retweet it, but I tweeted it yesterday. But they have, yeah, just that one. So that gives you an example of like, imagine all the mortgage-backed securities,
Right.
all the commercial real estate bonds, all of those bonds across corporate bonds that are trading down 20, 30, 40 points. The
Hmm.
losses on these things are just in the trillions of dollars, and what happens is after Lehman, the Federal Reserve forced the banks, gun to the head, to hold more bonds, right? And so because bonds are viewed as risk free, so the banks, and this is what you're getting at, and this is what people are starting to talk about. There's the two
Right.
guys in our chat that are talking about Bank of America and the hold to maturity losses across mortgage-backed securities, across treasuries, and all these things. Even the safe bonds are
Hmm.
down a lot. And when you're a bank, at some point you have to raise capital, and at some point the Fed has to step in. And when that happens, which should be probably, I'm watching credit default swaps on Bank of America every
Right.
day. Credit default swaps on U.S. Bancorp is a problem. U.S. Bancorp is like, if you look at, say, Texas Capital Bank,
Hmm.
it's a Texas bank. It's I think it's outperforming the bank index by almost 20%. And because they're exposed to Texas real estate primarily, it's a regional, it's what I call a super regional,
Right.
and it's a bank that we're looking to get long on the long side. But if you think of that bank relative to a bank that has a lot of commercial real estate in California,
Oh
this is
yeah.
like two different worlds, right? Two different
Yeah.
worlds. And so that's the U.S. Bancorp type risk, is that would stop the Fed prematurely. And if they get stopped prematurely by the beast in the market, that systemic risk, that's where you get this real kind of, next 2, 3 years, this elevated level of like 3 to 5% inflation. Whereas the last cycle, we were in the 1 to 2% regime. Now we're going to be in a 3 to 5.
And what happens to precious metals like, let's say, just gold and silver? Let's say the Fed eventually have to pump up all this liquidity into the system. Hypothetically, if a bank does collapse and there's just they just have to step in and save one of these banks, what would happen to silver and gold and the mining space? Would it take off immediately, or would you see a decline first and then a little bit of a rally? What do you predict?
Well, it's pretty simple.
Right,
If it's systemic and it's nasty, then what happens is correlation goes to one in the market, like it did with Lehman and during COVID,
right.
and you get a pretty nasty move down. The GDX traded. I never forget that. I think it was like the 18th of March. I think it was a Friday, and it traded. I think it I think at $20, and a couple hours later it was down to 12
Mm-hmm.
because somebody got the tap on the shoulder at a fund. Because what happens is you have to sell your good things to bail out your bad things. So a
Ah.
lot of times that's why correlation goes to one in a crisis, because you need liquidity, and so people will burn the furniture to stay warm in some ways. Like they will
Mm-hmm.
have to sell some of their good assets, or if the fund's getting liquidated, they just have. I mean, I don't know if you've ever known anybody that's taken over a liquidated book. During Lehman, some traders were getting fired in 2007 and 8, and I had to take over some books. And
Right.
it's a crazy experience because you take over someone's book. I took over a book of a trader that left the firm. And it was almost $1 billion. And when you're selling those securities, those losses are not yours. So you kind of indiscriminately sell. And so
Wow.
you just want to raise the capital. And that
Right.
creates this dynamic where for like a month or 3 weeks, gold and silver miners will be under pressure, but then that's just going to be a screaming buying opportunity.
Yeah, absolutely. And a lot of talk online, Larry, about the BRICS nations with Russia, China. They're adding more nations, six more nations just about a month ago, including Saudi Arabia. There's even talks of it being backed by gold. What do you think that would do to the US dollar long term if you have Russia, China, and all these other superpowers trying to move away from the US dollar? How does that affect everything? What the US dollar does, the Fed, gold and silver? What do you what's your thoughts on the BRICS nations? Will it succeed?
Well, there's a massive regime change going on, and this is what we talk about in my next book. It's called When Markets Speak. It'll
Mm-hmm.
be out in the first quarter, and it looks at the Lehman crisis and it looks at today. And in the book, I sat down with some famous political players. Going to leave this some of the names out for now, but like legendary politicians and legendary hedge fund managers
Wow.
and friends of mine, and also my best contact, Neil Ferguson, is a good friend. He wrote the forward, and he's probably Hall of Fame
Mm-hmm.
historian. And when I talk to these people, it's pretty clear we're moving into a multipolar world. And what's wacky about the market behind this
Mm-hmm.
is everybody's portfolio in the United States, like literally 18 trillion of wealth, is really set up for a unipolar world portfolio. And that's what
Interesting.
we had for the last 10, 15 years. And that's where the United States is the most dominant power. That's where the United States has a lot of allies. And there's not, there aren't that many dangerous spots in the world.
Hmm.
When you move to a multipolar world, it it really changes the whole risk profile of inflation, and it creates much more sustainable inflation. And then if you just look at the bond market, like Bank of Japan is now has higher inflation. So the
Right.
linchpins in the bond market that were holding down rates, like Germany, just the two, you know, Batman and Robin of the market
Yeah.
were Germany and Japan. And they
Mm-hmm.
were really the anchors of the global bond market. And though even those bonds are now drifting higher. So it's very clear we're coming out of a low yield unipolar world,
I'm going into a
low
multipolar.
yield unipolar to higher yield multipolar. And
Mm.
what that does is the setup is much more hard assets, value stocks, emerging markets, those types of things are going to do better. And the last decade's portfolio of the Magnificent Seven, it's just like literally the driest, stalest investment thesis out there is the last decade's darlings. I mean,
Yeah.
everybody, it's getting to the point of imbecile level. The amount, I mean, wrote a whole chapter on the dangers of passive investing. And this is sickening. You're talking sickening. People's 401ks, Americans' 401ks have been hijacked by like 12 stocks. And
Jeez.
nobody is on the conference calls. I talked to David Einhorn. I did a Real Vision sit down. He's a Hall of Fame, Greenlight
Mm-hmm.
Capital. He was up 35%, 36% last year. Like he is the top asset manager in the value space next to Buffett. And
Right.
he tells me he gets on these conference calls and it's all sell side analysts. In the old days, you would have active managers on these calls.
Mm-hmm.
You would have the banks, but you'd have a lot of questions, a lot of tough questions. Now it's the BlackRocks and the Vanguards and all these passive funds own all the shares, and there's not a lot of due diligence. It's not you're missing that checks and balances in the market that have
Right.
existed for like the last 60 years. And there's a point where when too much money, 3 trillion, 4 trillion has gone into passive in the last like 8 years. There's a point where when passive gets up to 50, 60, 70%, right now I think about 53, 54% of the
Right.
market. It gets up to, it's a point where there's not enough eyeballs really looking at the market. And there's a lot of dumb money just owning the same stocks because that's what's always worked. And that's what all going to end in tears. And that's what all that's going to transition more from the stale, last decade's portfolio to a new portfolio that looks like a 1968 to 1980 type of regime.
So eventually people's 401ks, because they're all tied up into those 12 stocks, could be wiped out.
Well, yeah, but I think people are starting to smarten up.
Yeah.
You're starting to see some transition. Well, you saw it last year. I mean, like last year, the NASDAQ 100 on January 1st,
Mm-hmm.
2022, the NASDAQ 100 was worth $20 trillion of stocks, and there 20 trillion in 100 stocks,
Right.
20 trillion. And as you well know, 50% of the NASDAQ 100 is in the top like
Yeah.
eight or so. So by December, that number got down to 12 and a half.
Mm-hmm.
So it went from 20 to 12 and a half of value in the NASDAQ 100. Then it went back to 18. Every time I turn over here, we might be at 16 by the end of the day. But we were at 18 trillion maybe in July, August,
Right.
and now we're probably back towards 17. So I think by the end of the year, another 2 trillion is going to come out of there and move toward hard asset companies. So
Mm-hmm.
your BHPs, your Alcoas, your Chevrons, your Southwest Energies, there's just so many companies that own assets.
Mm-hmm.
Hecla Mining,
Yeah.
great company in the United States. They own, it's a silver miner that has U.S. assets. It has U.S. assets in Canada, and it owns silver. It owns properties that have access to incredible minerals.
Right.
And so that's where you want your. I think literally like 5 years from now, when you look at the top holdings of the S&P 500, you're going to see a BHP in there. You're going to see a Rio. You're going to see a Chevron. Where right now there are pretty much no hard asset companies in the top 10 names.
That's super interesting that you pointed that out. And Larry, everything that we talked about today is just it's been incredible. So we want to thank you all from Wall Street Silver and myself for coming down and talking to everyone. And where can people contact you? Where can people find you? And obviously we'll put it in the description below. But where can people find you?
Well, on Twitter, it's at ConvertBond,
At, at Convert
And
Bond.
on Bloomberg, you just look for Lawrence McDonald. And our website is the beartrapsupport.com.
Yes.
And on Amazon, our last book, it's in the top 20 all time at the CFA Institute. It's a New
Wow.
York Times bestseller. And it's a colossal failure of common sense, the inside story of the collapse of Lehman Brothers.
Well, you know what? We thank you so much, Larry, for coming down to Wall Street Silver. And hopefully we're going to keep an eye on Powell as the market develops. We'd love to have you back on to talk to everyone.
Yeah, Powell's heading for the handcuffs soon. So once they stop the Fed,
Yeah,
hard
he's
assets will be in the driver's seat.
I totally agree. Awesome. Talk to you soon, Larry. Thank you so much.
Thanks, Evan. All the best.